guys, my friend Lakshmi saved 4,000 rupees in a piggy bank. She decided to deposit this money in a bank. At the bank, there were two options, 20% simple interest or 20% compound interest. Lakshmi was clueless about the difference between the two. So she put 2,000 rupees on simple interest and another 2,000 rupees on compound interest. 2 years later, she checked her bank balance. The bank account with simple interest amounted to rupees 2,800, whereas the bank account with compound interest amounted to rupees 2,880. Why is there a difference of 80 rupees in two returns? Let's find out. Let's look at the simple interest account first. Lakshmi deposited 2,000 rupees. The rate of interest is 20% per annum. At the end of year 1, the interest accumulated will be 20% of the principal, which is 20% of 2,000 equals to 400. Thus, at the end of year 1, the bank balance will be principal plus interest, which is equal to 2,400 rupees. Moving on to year 2. For the second year, the interest will again be 20% of the principal. The principal remains unchanged at rupees 2,000. Thus, the interest earned is 20% of 2,000 or 400 rupees. So at the end of 2 years, the balance in the account will be the principal plus interest for the first year plus interest for the second year, which is 2,800 rupees. Let's look at the account with compound interest next. The rate of interest is 20% per annum. At the end of year 1, the bank balance will be principal plus interest, which is equal to 2,400 rupees. Guess what? At the end of year 1, both the accounts had the same bank balance. Then where does extra 80 rupees come from? Hang on. It is from the second year that things start to change. In the account with the compound interest, the principal for the second year will not be the original principal. The interest earned during the year 1 will add on to the old principal to give us a new principal for year 2. Thus, the principal of year 2 will be 2,000 rupees plus 400 rupees or 2,400 rupees, which is the bank balance at the end of year 1. The interest earned will be 20% of this new principal. So 20% interest of 2,400 for the second year will give us 480. Now the bank balance will be 2,000 rupees plus 400 rupees plus 480 rupees, which is equals to 2,880 rupees. In simple interest, the principal does not change. It remains the original 2,000 rupees every year. On the other hand, in compound interest, the interest earned gets added onto the principal, giving us a higher principal in year 2 than year 1. This is why we end up with more money. There's where this extra 80 rupees came from. In case of compound interest, it can be a tedious task to calculate the new principal year by year, adding on the interest earned in the previous year. We can use a formula to make things easier. A principal P rupees, compounding annually for T years at the rate of interest R percentage per annum amounts to this expression. Let's check if this formula works. We know Lakshmi deposited 2,000 rupees for 2 years at 20% per annum. The amount after compound interest should be given by simplifying the expression gives us 2,880 rupees. There you go, the extra 80 rupees again. Wasn't that easy? Wasn't it fun learning the difference between simple and compound interest? See you next time.